Big Money just placed a big position in this beaten down name that they are looking for prices to jump higher. Now, there's a couple different reasons we'll talk about why this could happen, but we're looking at about a $3 million bet placed in the option market where they're betting directionally prices are going to go higher. Now, if prices don't go higher in the next 6 months, they lose it all. So let's take a look at what I'm talking about here and dive into it. So we're talking about Melco Resorts here. This is an ADR. This is focusing on the casino name or the casino sector over in Asia. But as we see here, this has been beaten down here, and we're getting to levels where it popped before. But today we saw a big trade take place in the January expiration here. So looking technically here, we wouldn't really necessarily look on a daily. I may look on a monthly. Well, let's just take a look here at the weekly here. So we had a pop higher back in earlier in the year, popped higher, came back down, and we kind of see it's been doing this. It's a very up and down stock. Now I don't know exactly what's going to benefit the stock to move higher specifically, but there's two things I'm looking at here. So they just announced that they're doing about a $500 million buyback on these levels here. So what that means is that there's going to be a natural bid underneath the price floor here, underneath the market here. The other thing too on this, we're just going to move this back to daily, and I'm going to walk through here. It doesn't show here that there is a yield, but I made sure that they didn't suspend the dividend. But from what I quickly looked at, it's got about 3.5% dividend yield. So you're going to get some dividend interest, and you also have the buying of the approved buyback of the company buying back their shares. Now, it's not necessarily a great thing, but that puts a natural bid underneath the marketplace where there's going to attract some interest and may see prices pop higher on that. So what we're looking at and what I'm going to discuss with you is this activity here where we saw 20,000 contracts, 20,700 contracts trade in this 18 contract here. It's 18 strike. Now, they were bought. They traded on. They traded off the market here. They called this in. It was a big trade. Let's clear the filters here. And you can see here that the 10,000 of those contracts, this was all grouped together, but when they report this is how the reporting looks like. So 10,432 contracts at a price of $1.45. Altogether, that's about 2.5. If we do 17,000 contracts, it's about $2.5 million placed betting that in the next 199 days, prices, we got to look at $18 plus that $1.45, so above $19.50 break even. So that's what we're looking at here. Now, the other thing where I get notional value from is what this controls, and that the leverage is that we take the volume times the delta, so 20,700 contracts times 45, which is the delta, and then times that by $16.50. That's a closing price. That's the current price of shares. That's what this position that they purchase controls, and it's about just over $15 million. That overall, if they purchase that position right now, they use $15 million of stock. To have that same equivalent, they use the option market, and they use that, and they buy these calls here. Now, is this the best way to trade this one? Buying these 18 calls over the long term? I would say probably not. This is a institution. This is a firm putting on this position, not knowing exactly what they're looking for or what they're putting money behind or why they're putting money behind. I think there's a little bit more of a couple different ways to position this. I mean, you could look at even doing a spread that gives it time, or you could look to buy something that's in the money. And what we're doing here is just going through an exercise. I mean, we have a thesis, we have a signal. How do we best utilize that? And we walk through different scenarios. What best fits your risk tolerance or your activity in the marketplace as well. So I would look at this in a couple different ways. I try to position that same way. They're looking for something to happen over the next 199 days. So that being the position. Or the time frame where we're looking at, how I would probably position that is that we don't have too many cycles. Some of them would open up after July expiration happens in 10 days. The September will open up for this one, so it gives it a little bit more cycles here. So in short here, what I would probably do is look for something that's a little bit in the money, has some intrinsic value, and sell something that's out of the money in these cycles within 45 days here. So that would be one way to look at it. It's not so beaten down. Where I mean, the other way too is buy a stock and sell calls against it. You could do that kind of position, or you could do puts as well. So there's a couple different positioning, different ways to trade this, and that's why there's always more than one way to make money in the financial markets. But the most important aspect is this positioning here. What we see is that this is an institution that's putting big money behind it. This is a $2.5 million position, and they are looking for shares to go higher in the next 199 days. Now, if it doesn't, this trade loses it all. They're not going to be. I mean, they may try to roll it into more, roll it into something else at a loss, or they may roll it for a profit. But they're not going. They don't have a stop on this. This is the position they put on. This is what they're willing to risk. They're rolling $2.5 million. So that's why it's meaningful. This is why it's interesting. So keep an eye on this one over the next 199 days, and let's see where it goes. I'll see you in the next video. Make sure you leave a comment below and let me know your thoughts. Like the video and share it with a friend.